Now here is Ticky Fullerton on Your Money.
Hello there and welcome back to Ticky. I'm Ticky Fullerton, back with our flagship business show with a full hour of in-depth coverage of what we think really matters out there in the world of business and markets. Coming up today,
1.25 million new jobs created over the next 5 years.
The Prime Minister's pitch to Australia: stick with us or face a weak economy under Labor. We asked Deloitte partner David Rumbens how the PM's promises fit with his latest business outlook. The Australian's editor-at-large, Paul Kelly, brings us his assessment of the campaign so far. And we look at Scott Morrison's latest fillip for small business, a bigger instant asset write-off. Online parcel delivery business Sendle CEO James Moody tells Chief Business reporter Leo Shanahan what he thinks. And on the results front, debt collecting, paying dividends. Credit Corp posts half-year results which send the stock up. Chief Executive Thomas Beregi with his US growth story. Well, 2019 is shaping up to be more action-packed than Avengers Infinity War. There's a lot of action in that, I can tell you, having seen it. Action both here and around the world. So we're hitting the ground running as we head into reporting season this week. In the United States, we're already into results with the big four techs, Apple, Amazon, Microsoft and Facebook, all reporting this week. Plus, we've got a rates decision by the Fed due, with the market betting on a no change. And fair to say, the US market has been on quite a comeback in January after that rather sad, Santaless ending to 2018. The S&P is up over 6% so far in January. And why? There's a lot of commentary around Donald Trump's big backdown on the government shutdown. But is that story really over? What will happen in 3 weeks' time when he threatens another shutdown and using those emergency powers? Just what is going on in the head of the US Commander-in-Chief as he balances domestic politics with another hugely important story for markets, the US-China trade spat? Well, pouring into Washington this week is a very senior Chinese delegation headed by the Chinese Vice Premier for talks with the White House. And Mr. Trump has given him a bit to think about on his trip over, with the United States overnight laying charges against Huawei for fraud, ramping up the already tense situation. Remember, Huawei's CFO is under arrest in Canada, facing possible extradition to the United States. Still, if the trade standoff continues, then March the 1st is D-Day for another hike in tariffs between the two big superpowers. March the 29th is the other date for international markets, Brexit withdrawal day, we think. Will it actually happen? Well, more of that over the next couple of days as British Prime Minister Theresa May desperately tries to refashion her Plan B, or is it C, with different sides of her own party throwing up amendments in Parliament this week on everything from removing the no-deal option altogether to removing the Irish backstop altogether, everything in between, including a postponement of the March 29 withdrawal date. Having spent a bit of time on the ground in Britain in the last couple of weeks, it's still extraordinarily unclear. A delay of Brexit is pretty likely, but note that Britain too is reviewing its emergency powers in case of riots. Look, there's so much out there for markets to look at, including those lower growth numbers out of China. We'll get a bit of help on that in depth with the in-depth look at the Deloitte business outlook in a moment. So buckle up for a big year abroad and a shake-up in Australia with an early federal budget, a federal election, a New South Wales state election, and just ahead, the final Hayne report. All will be revealed on what should happen to our financial services sector. Right, well, more than anyone, the Australian business community is nervously awaiting the release of Commissioner Kenneth Hayne's final report on the Financial Services Royal Commission. We've today been given a little more on the timeline of events in the lead-up to the report being released to the public. For more, Your Money's Chief Business reporter Leo Shanahan joins me live at the desk. Leo, what do we know?
Oh, welcome back, Ticky.
Thank you very much.
Well, look, we are getting the report. The short answer is on Monday.
Because we thought maybe it was Friday, this Friday.
Yeah, so we'll get the report under embargo on Monday. There'll be a media lockup and then it will be released publicly at about 4:10 on Monday, the 4th of February. Now, the logic being it will arrive with the government, I understand, on Friday still. Yes. But there was a lot of wargaming on this subject in the last week in Treasury, and there was Firstly, they ruled out releasing it immediately because it was ruled as too market sensitive, and they needed a sense of how market sensitive that's going to be. And Friday afternoon just seemed too risky. Waiting till after 4 on a Friday afternoon after media response is not ideal. Saturday's not a good day to release anything. Sunday was considered a lock-up on Sunday going into that, but obviously then Monday was settled on as a more practical example.
And
with
of course,
publicly released.
4:30 on Monday is Ticky, so you can come on
Yes.
10 minutes after you get out of the lock-up and talk to us all about
Well,
it.
that will be good, yeah. So, look, it should be, it's interesting the way the government has handled it. I think, obviously, they'll cop it from Labor for not releasing it immediately. I think that was always going to happen to some degree. But could they release it blind? No. But I don't think they'll try and be too smart with it. There was thinking that maybe they hold it for a couple of weeks and put out a kind of official response to it. Their response, as I understand, will be pretty generalised.
But given that they never had control of this thing, they were on the back foot because they didn't want the Royal Commission in the first place, presumably sitting on it for 2 weeks after that would have been untenable.
Completely untenable, and it would have leaked, I think.
Yeah,
to some degree,
and
anyway.
a different strategy from Labor as to what they're going to do with Hayne as opposed to what we know what the government's going to do with it.
Yeah, well, Labor are accepting all the recommendations blind, which I'm not sure is entirely...
That's quite out
there's
there,
such
isn't it?
as the
It's a big
political
call.
capital in this, I think, for Labor at the moment, who have been ahead on this from day one. Why give up any ground now? And they seem to think the controversial areas they probably largely will agree on, and super is the one that maybe could have hurt them, but the way in which the Royal Commission conducted itself around super, it really hardly tickled up the industry super funds, and that's what Labor would have been scared on. They're happy for them to put the boot
Really
into the
interesting,
retail
though,
funds.
if the Productivity Commission report, Karen Chester's reports, get somehow wound into the recommendations of the Royal Commission, maybe that might not be what Labor would feel.
Yes, and I mean, my understanding the Productivity Commission actually thinks that some of their recommendations will be kind of wound in or have been reviewed as part of the Royal Commission report. Now, if that happens, it would be interesting to see if the industry funds come out untouched and whether that policy of accepting the blind recommendations is a good one for Labor.
Leo, do you think, I mean, you've covered this so closely for so many months now, we've had the interim report, but that really didn't give us much idea as to where Hayne was going to land. What do you think will be the big areas the market will be focusing on? I mean, they went all the way to possible open findings of criminal.
Yes, and I think, look, this is something that's not been really addressed in a lot of the commentary yet. Obviously, people don't seem to think that the idea of anyone of specific recommendations around criminal charges against organisations or even individuals is particularly likely, but it is open to the Commission to have that. I mean, Rowena Orr did recommend at the end of several hearings that the Commission could find criminal breaches, and in other Royal Commissions, criminal recommendations have been made directly, which are then followed up on. So, look, it's obviously not a huge chance, given the nature of the interim report, didn't lend itself to that kind of thinking, but that's only an interim report. A lot could change.
And a lot of weight, obviously, on Kenneth Hayne's shoulders in terms of, I mean, he has the power to blow up business models, hasn't he? Do we think he's going to do that?
I mean, look at the likes of AMP. It continues to struggle, but really, if you had something like a criminal recommendation against the organisation or even an individual, you had something like the abolition completely of certain charges that their financial service providers use, or within their super models. I mean, this could really... You could be on the verge of the company actually going under on the basis of this report. And I don't think that's an exaggeration.
Very big day on Monday. Great to be back. Great to talk to you. Leo Shanahan, thanks very much. Deloitte Access Economics has flagged that recent good news on the economic front might well be the flash in the pan. Deloitte's December quarter business outlook warns that recent economic strength may only be temporary and that any permanent policy decision made post-federal election may not be sensible longer term. Well, this as the economy braces for Hayne, all the while already battling a credit crunch, drought and a housing crisis. So where to from here? Well, I spoke with Deloitte's David Rumbens a little earlier. David Rumbens, there seems to be something for everyone in your report, but the Prime Minister today, he's talking about the prospect of another 1.25 million jobs. Looking at the growth outlook, do you think that's achievable?
Look, it is actually a realistic ambition. Employment growth has probably been the best news story or the best economic feature over recent years. If you look just at the last 2 years, we've put on more than 600,000 additional jobs. It probably gets a bit harder from here because the global environment is slowing and we're starting to run into some skill shortage issues. But that part of the Prime Minister's statement, I think, is a realistic target if we maintain the broader economic momentum and have policies which are supportive of that.
Right. Now, more broadly, of course, we're hearing everywhere that global growth, growth in China is coming off a little bit. How should Australia read this?
Look, I think we read it as just that the growth is coming off a bit. 2018 was probably the peak in this cycle for global growth, and most of the major economies will probably be weaker in 2019, and China is obviously our key trading partner and important source of investment, and the fact that China is weaker is significant for Australia. That said, China's stimulus to offset that weakness is actually helping to boost commodity prices. So we're getting some income dividend from that. But broadly, yes, the economic picture is weaker, and we would expect that in Australia our overall GDP growth will be weaker. A little weaker in 2019 than it was in 2018 as well. Yeah,
but ironically this stimulus in the short term, a good thing for Australia, coming out of China perhaps. Coming back to, again, potential new job creation, that sort of growth, we've got company results coming through over the next 2-3 weeks. Are we going to see that reflected, that sort of optimism, do you think, reflected in company results?
Look, I think we are in some sectors. I think probably the more export-focused sectors, those sectors that are more linked into services provision and government spending. These are the areas of the economy still doing well. So we might see good results there. If you look at the more constrained sectors, particularly those linked to the consumer, where we've got high household debt, so retail companies, the housing sector. This is the area of the environment that's likely to be weaker, will continue to be weaker going into 2019. So those are areas which results may not be as strong.
Yes, I see Queensland jumping up and down about the property price falls in Sydney. It seems to be sort of driving people north. Is that right?
Yeah, so look, we've had some interesting patterns in state-by-state growth. That the last few years it's really been Sydney and Melbourne, and that southeast corner that's led Australian growth, and that's all then been reflected in property prices as well, as employment gains have been strong, drawing people in, and property prices have gone up as a result. We're seeing a mixture now. We're seeing some people starting to leave Sydney, and the data suggests that some of them are going north. So we're seeing interstate migration back into Queensland, not at the kind of record levels that we saw 10, 15 years ago, but there is now a steady inflow. And we're starting to see, not yet population flow, but some additional spending in WA as well, particularly from the mining sector. So we might actually see a more even picture in 2019 across the states than we've seen for some time.
Yeah, just looking more again at the sector side, mining continues strong. Interestingly, health has a very healthy outlook.
Look, those sectors that are aligned to government spending, that has been a strong area. Of late we've had, we've seen New South Wales and Victoria very strong infrastructure spending. We are seeing revenue stronger at the federal level, and a concern we have is that might be a temporary boost through company taxes, but it's certainly coming through at the moment and is likely to underwrite a predicted surplus for next year. But it is also allowing additional spending in areas like health and education and social services.
What about political risk? You almost say in this report that politics are really a side issue these days because of the broader power, I suppose, of social and communications. But what about the budget and surpluses? But what could be done as well, given we've got a major election coming up?
Yes, well, look, we have gone through, I think, 11 years now of budget deficit. So we have gone through a long period where we've run up the federal debt. It looks like we're on a better budget path now to something which is going to deliver a small surplus and projections of a small surplus going forward. The risk is we get carried away with that and increase our spending as a result, and that's particularly a risk because some of the revenue growth of late has been driven by that China stimulus and some one-off growth, we think, in company tax revenues, which may not be as sustainable going forward. So a more prudent strategy would be to bank some of that, or if we are spending, to reinvest it, particularly in areas like infrastructure and education. That there may be the risk to instead go with policies like tax cuts and handouts. And
anything you see in the Prime Minister's economic speech today to indicate that there is that prudence there, particularly on the debt front too?
Look, the ambition of no federal government debt, no net debt by 2030 is a grand one, but we haven't seen a budget surplus for a long time. I think let's get one or two in the bank before we can think that those sort of ambitions are actually realistic. And if it does temper the tendency towards additional government spending in the short term, then that will be good. It is, we have over that decade of budget deficits actually had reasonable economic growth, and yet we haven't been able to deliver a surplus over that time. So, if we can move to that position and those sort of ambitions help to lock that in, then that will be good news for the economy. Yeah,
but what you're saying is really the Prime Minister today, it's more realistic on the jobs front than he is perhaps on some of his debt ambitions. What are the other risks that might occur this year? And I'm thinking in particular of what the Hayne report might bring down.
Yes, well, look, I mean, on the domestic side, it's it is the finance sector, and I guess how that links to the housing sector, which causes some economic risks. Where we are seeing a more constrained lending environment. That's facilitating a pullback in housing. Arguably, housing prices and housing activity ran ahead of what it should have anyway. So we're perhaps returning to a more normal position, but the concern is that we then get overdone on the downside, and people become afraid to lend and afraid to borrow. We're seeing that in some of the sentiment indexes. Consumer sentiment is down. The business sentiment surveys are not as strong as they were, even though underlying business profitability and conditions are still quite strong. So,
yeah. But then we've got the drought as well, of course.
And the drought, there's clearly some negatives, and overall it's probably going to be a more challenging 2019 than it was 2018, for the farm sector, for housing, for retail. But we do have record infrastructure spend. We've got the mining sector lifting its head again. We've got great results out of tourism, international education. So there's some sectors that are still doing very well.
Right, David Rumbens, thank you very much for all your analysis. Great.
Thanks, Ticky.
And after the break, Credit Corp releasing its half-yearly results. They're pretty good. We'll get all the latest with the CEO, Thomas Beregi, next.
You're watching Ticky on Your Money. Now, back to Ticky.
Yes, welcome back. Well, shareholders in Credit Corp are pretty happy today after Australia's largest debt collector and buyer of those things called purchased debt ledgers released its half-yearly results. Well, half-yearly profit came in at over $33 million, up 13%. Revenue rose 8% to $159 million, over 8% rise over last year, with the results really reflecting the outperformance of its consumer lending and US segments. According to the company, it's also upped its net profit guidance for the year 7 to 9%. Well, shares are shot up off the back of the release. For more on those results, Thomas Beregi, CEO of Credit Corp, joins me. Thomas, welcome to the show. Pretty nice half-yearly result for you, and all, as I understand it, really driven by the US market and your growth story there.
That's right. Both the US and our Australian consumer lending are the two newer businesses that we've been in just for the last 6 years, and both were developed organically. Yeah. So very pleasing.
So The United States, it really is, your company, a tale of two different markets at the moment in terms of, if we just look at your debt acquisition business. Why is the US in a sort of slightly different place in terms of how you can operate there?
Yeah, look, right at the moment, it's a function of competition. So the competition to buy purchase debts, and right at the moment, paradoxically, the US is less competitive than the conditions we're finding in Australia.
Because you really went in there, what, a couple of years ago from a standing start. So what has driven your ability to essentially grab market share from the incumbents, or has the whole market grown?
Yeah, look, a couple of things have happened. In Australia, we've always had a strong compliance focus, and so when we came to the US, it was we were still feeling the effects of the GFC and some of the tighter regulation, and a lot of the major banks were very appreciative of our collection approach and the way we dealt with consumers, the more limited use of litigation in the collection process, and that enabled us to get traction with a lot of the major banks over there.
So, Thomas, the economic cycle must drive whether you've got opportunity or not. I mean, at the moment, and what's the best time of the economic cycle for you to make money?
Yeah, look, for us in the debt purchasing business, a lot of it focuses on capital and credit availability for our competitors. We try to be the most disciplined operator in any market. So we only buy debts if we can ensure that we'll make a return, we'll deliver a return.
But it's not at either extreme of the cycle.
No,
it's really
generally at turning points, I guess, are good for us.
Well, that's the US right now, isn't it?
That's right, yeah. Corporate credit is probably a little bit more constrained in the US, but generally consumers are still in reasonable shape over there.
Rates going up, though, slowly, aren't they?
Rates are going up, and that's affecting some of our competitors over there who use a lot more leverage. They use a lot more debt as part of their financial structure, where we tend to be a lot more conservative. More equity.
So, because presumably, obviously, if you're buying other people's debts that they can't manage, or they don't want to hang around and manage, presumably you've got to have your own scrutiny there, because if markets change dramatically, you could be left with a whole lot of toxic debt.
That's right, that's right. So we do a lot of due diligence on the debts we purchase to determine the amount we're prepared to pay that will deliver us a return.
But you really see the growth coming out of the US going forward now?
Yeah, right at the moment, the US represents a tremendous opportunity. In Australia, we are the largest debt purchaser, and we're a big part of the market, a market which is not necessarily growing. The US is a large market which is growing, and at the moment we're a very small part of it, so it's all upside.
Now, what about the constraints on lending that have been put in the last year or so by our regulators, both, housing but also small businesses, access to borrowing?
Yes, that's certainly coming to bear in terms of the volume of consumer lending. If you look at total credit card issuance in Australia, the total amount outstanding in balances on credit cards, it's actually
so that tightens your
falling.
Opportunity.
That's right. That's right. So,
and what about Hain? On Monday, when the Hain report comes down, anything that sort of could concern you, or what will you be watching for? Yeah,
well, we'll certainly be watching for what standards he sets for business conduct in financial services. Obviously, our business wasn't within scope of the Royal Commission, but like any financial services operator, we'll be interested in what standards he articulates. We think we do a good job in terms of being a compliant and sustainable business, but if there's a standard he articulates which we don't meet, we'll have to respond. So on the lending front, on your consumer lending front, Wallet Wizard, I think you said, is the most competitive product of its type on the market at the moment. Are you concerned that regulators may look at this? Because it's not payday lending and it's not pay now, buy now, pay later either. But that's been in the eyes of ASIC, hasn't it? Those buy now, pay later companies. Are you concerned that the regulators may come and look at, frankly, you're paying high rates, aren't you, to borrow fast cash? Look, the type of lending we're doing is not cheap, but it is cheaper than the alternatives, substantially cheaper than the alternatives. If you borrow $1,000 from under a Wallet Wizard loan over 6 months, you'll pay $148 in total interest and fees. If you borrow the same amount from one of our competitors, you're talking $440.
And is that market going to move at all? I'm thinking of open banking and the whole issues of privacy, because don't you have to, if I borrow off you, I have to open up my accounts to you and everything else, share my data with you?
Yeah, there's a certain amount of data that we'll require as part of the underwriting decision, and that's not so much a function of open banking, but it's a requirement to ensure we meet our responsible lending obligations. So,
but that could move as data changes.
That's right, and certainly
banks decide whether they're going to pay for your loss if you get hacked, or whether now that I've shared my data with you, that means that they won't pay me, and all that sort of stuff's got to be sorted, presumably. Yeah,
certainly. We think we maintain high standards of data security, so hopefully we'll be insulated.
It's a fascinating area.
It is.
Thomas Beregi, I'm out of time, but thank you so much for coming in, and well done on your results.
Thank you.
OK, well, after the break, Scott Morrison takes to the election campaign trail. He's pledging more jobs and greater incentives for small business. We'll find out what to make of all this with the Australian's editor-at-large, Paul Kelly, next.
This is Ticky on Your Money, covering the big business stories.
Yes, welcome back. Well, Scott Morrison moved the campaign trail off to Brisbane today with a pretty major economic speech where he's pledged to expand tax write-offs for small businesses which buy new assets. The Prime Minister's also promised to create 1.25 million new jobs over the next 5 years if the government is re-elected in May. He also sees Australia's net debt falling to zero, I think, sometime in 2028-29. Well, more now from Sky News political reporter James O'Doherty.
In what was billed as a major economic speech in Brisbane, the Prime Minister was highlighting his government's record in creating jobs, more than 1 million over the past 5 years, and pledging to create 1.25 million more if the government is re-elected in the May election.
We will create 1.25 million jobs over the next 5 years. That's my pledge. That's our pledge. When we were first elected to government, we said we'd create 1 million jobs in 5 years, and we did exactly that.
But Labor has cast a shadow over this pledge and also the government's record in creating jobs over the past 5 years. Jim Chalmers suggesting that many of the jobs created by the Abbott, Turnbull and now Morrison governments have been part-time jobs. Also, Labor is emphasising that it's private business that are creating many of these jobs rather than the government.
I mean, I think when we look at the creation of jobs, Australians deserve credit. Australian business deserves credit.
The government says more than 675,000 of the jobs created in the past 5 years have been full-time. Only 563,000 have been part-time. This is all part of a government strategy ahead of the election to hone the economic message, emphasising the good management of the economy under the coalition and highlighting just how bad it would be under Labor. After Christopher Pyne suggested a Labor government could tip the Australian economy into recession, that word wasn't repeated by the Prime Minister and by the Finance Minister.
They left behind a weakening economy, rising unemployment and a rapidly deteriorating budget position. A shortened Labor government, the economy would be weaker, the country would be weaker, Australians would be poorer.
Government ministers this morning couldn't get their story straight on this ridiculous scare campaign. We had Chris Pyne, Matthias Cormann and Scott Morrison all contradict each other.
As well as a commitment to create 1.25 million jobs over the next 5 years if re-elected, Scott Morrison has also made an announcement regarding extending the instant asset write-off for small business, allowing small businesses to write off the cost of purchasing new assets for their small business. The government says this has been a particularly popular initiative since it was first introduced by the government some years ago. James O'Doherty, Sky News, Canberra.
Well, the Australians' first news poll of 2019 must have been a little welcome relief for the Prime Minister of his Weet-Bix this morning. You'd think he'd be eating Weet-Bix, wouldn't you? It reveals a 5-point turnaround since December, with the Coalition's primary vote up 2 points to 37%, Labor down 3 points to 38%. Now, does it mean that the Coalition is back in with a chance of staying in office, even with some MPs heading for the exit? Well, the Australian's editor-at-large, Paul Kelly, joins me now live at the desk. Paul, great to have you here. What of the polls and what of his speech, the Prime Minister's speech?
Well, Scott Morrison's trying to put the economy on the agenda. He wants the election to be dominated by the economy. That's the strength of the Liberal Party. It's the strength of the government. But this comes after nearly 3 decades of economic growth. The electorate is complacent and indifferent on the economy. Scott Morrison is saying, listen, if you want good health, good education, good childcare, it depends on good economic performance. But whether he can actually get that message through and persuade people to vote on the economy is going to be a lot more difficult.
As you say, it's a message that they've been running for years and years and years. So when, say, Christopher Pyne is out there this morning and talking about, oh, well, there'll be a recession under Labour, and then you've heard the, Matthias Cormann and the Prime Minister backtracking or not mentioning the R word. What do you make of that? Is that a bit of a media beat-up?
Well, the government can't mention the R word. It would be folly for the Prime Minister to start predicting a recession. That, I think, would be a negative for the government. The point being made by the Prime Minister, I think effectively in his speech today, and also by Matthias Cormann as Finance Minister, is they, not surprisingly, predict that under Labor the economy will be weaker, there'll be fewer jobs, it'll be a more difficult road to hoe for business investment.
Yes.
And consequently it'll be more difficult for households. Now, it's not surprising that they put out that message. We'll hear plenty of that message, but the real focus of the government, I think, when it comes to the economy, will be the big scare campaign on Labor's taxation policies. There's no doubt that is the government's great hope here of persuading people to change their vote. We're talking here about the franking credits for retirees. We're talking about the negative gearing for housing investors. And
in a falling market.
Exactly. And so we'll hear a lot about that from the government.
One of the really interesting developments in the last week has been in Tony Abbott's electorate, Paul, where we've now got Zali Steggall, former Olympian, coming forward and saying that she's going to take him on. Now, how do you see this playing out?
What we're seeing here, Ticky, is a revolt by a section of the middle class on climate change against the government. And this is different to the main game, Scott Morrison versus Labor, but this is a distinct problem for the government. It's one of the consequences of the leadership change. If Malcolm Turnbull was still Prime Minister, and if the neg had got through, then the environment about climate change would be quite different. But this is a government vulnerability now, because the government has no real policy when it comes to climate change. Its focus, of course, is cutting power bills, but it can't really do much about that. So it's exposed to an attack by parts of the middle class that are socially progressive, that are concerned about climate change, in the form of running independent candidates in well-off, established Liberal electorates, where climate change is a moral issue. And the government, I think, can't really defend itself very effectively on that front. And so I think this will be a problem for Scott Morrison in the campaign, and of course, while Tony Abbott's a very strong local member, a problem for him as well.
Right, so you've got Zali Steggall up there, and immediately Karen Phelps gets airtime to support her, and that's the member for Wentworth now. As you say, this is something that is looking at individual seats, but it's a trend in some, particularly inner city seats and leafy seats, I would think.
Well, it's got a bit of momentum. You've got a roller coaster, but of course the reason it's got momentum essentially was because Malcolm Turnbull was rolled, he quit, there was a by-election in Wentworth and the Liberals lost. And that's given a lot of momentum to this idea of the independents. And it's a particular cohort here. We're talking about female candidates running on compassion, on socially progressive agendas, on climate change, and attacking the government, saying that it's too conservative and out of touch.
How split do you think the Liberal Party is in Australia? Would there be some Liberals wishing Zali Steggall great success?
Well, there are. We know that there is a grassroots revolt in the Liberal Party in Tony Abbott's seat, and that's a problem for him. Now, I want to be very careful about this. He's been the member for a long period of time. He's a very effective grassroots campaigner. He's got more loyalty in that seat than many people recognise. It won't be easy to dislodge him. Nonetheless, he's got a real fight on his hands.
Goodness me, Paul Kelly, it's going to be a very exciting campaign. I do hope you'll come back 2 or 3 times before election, but thank you so much.
Thanks, Ticky.
Right, well, what a campaign it's going to be. Now, Sendle An online parcel delivery service taking on Aussie Post has today raised $20 million in a Series B funding round. The company says it'll be using the latest cash injection to double down on its challenge against Australia Post and explore its options overseas. It was good timing for the announcement with the federal government today increasing the instant asset write-off threshold for SMEs to $25,000. For more on Sendle's future, Your Money's chief business reporter Leo Shanahan spoke with CEO James Chin Moody a little earlier.
James Chin Moody, thanks so much for joining us.
Thanks for having me.
Now, look, I wanted to start off asking you about what Sendle is, because frankly, a lot of people might not have heard of you. You set yourself up as a rival to Australia Post, but how do you just differ from a normal courier service?
Yeah, so Sendle is a courier service that's built 100% around the needs of small business in Australia. In fact, that's our purpose. We help small business thrive by making parcel delivery simple, reliable and affordable. And what that means is what we do is we actually unlock all this huge amounts of logistics infrastructure that's normally reserved only for the really big businesses, and we unlock them for small business, which means we can do parcel delivery cheaper than lining up at the post office, and we can send your parcel door to door anywhere in Australia and indeed now anywhere in the world. And again, cheaper than lining up at the post office. So
how do you partner with those big logistics firms that would otherwise just be dealing with the post office? Yeah, well, it turns out that there's lots of, we can see them all the time. There's trucks driving on the road all over the place. Those trucks are not necessarily full. And so what we do is we identify the idle capacity in those trucks, and we work with our providers to actually fill those trucks. And because we do that, we effectively can get better rates for our small business customers. But there's no limit in the service. In fact, we choose based on the quality of the service so that we can actually send parcels anywhere in Australia and anywhere in the world. Yeah, so if you're reliant upon idle capacity, does that mean you can't always get it within a time frame that you'd like? In fact, it's actually the completely opposite. Right. Because our network chooses on quality, we actually have now a pickup guarantee that we build around our service. We've got a price guarantee that we will be cheaper than Australia Post for our same city and national partners. And for some of our providers, for some of our customers, we have a delivery guarantee. And we worked very closely with eBay, for example, to create a 2-day door-to-door delivery guarantee. Yeah, we'll talk about some of those partners in a moment, but look, you've got a new $20 million in Series B funding. You must be pretty happy with that. And it's Federation Investment, Australian private equity firm made up of former Macquarie guys. How do you feel about that? Yeah, look, we're absolutely delighted. Federation's a great firm. They're very smart and adding a lot of value already in terms of strategy, but also very values aligned. We're also the only 100% carbon neutral delivery service in Australia, and they, as well as investing in PE, also invest in renewable energy. So, they're our new investors. Our existing investors, which are Rampersand, Full Circle, Giant Leap, they came back as well, which we're also delighted by. And together, I think we're really going to be fueling growth. So with that 20 million now in Series B, is that what is their ownership of the company? So look, we don't release the actual pre-investment valuation. That's all under confidentiality. But really, I'd say for those who know how these things work, it's a very typical round. One of the things I like is that you might say we're living the startup dream in the sense that we're very typical compared to the normal metrics you see in this space. And Neil Brown joins the board, I understand? Neil, he's from Federation. He joins Rowan Grant, who's also from our Series A. He's from Full Circle. Okay. Now, look, you claim, I am interested in your customer base. There was in your release, saying customer base has increased by 600%. Another way of saying that, it's grown 6 times. But what is the customer base at the moment? What does it look like? What are those numbers? Yeah, so this is the thing that really, I think, was the big insight that helped us to see that Sendle was needed. Really, in Australia, when you just look at small business and their parcel delivery needs, we have a functional monopoly in place called Australia Post. Really, many people don't even realise there's a choice. If you say, I need to go and send a parcel, the first thing that jumps into their mind is, I need to go and line up at the post office. And you might say that when you have a habit that's, that is as ingrained as that, a monopoly wrapped in a habit is almost invisible. People don't know that there's an option. And when we realised that there was very few options for small business in Australia, that's when we realised that actually there was a room for an alternative. So Sendle's core market and who we're here to serve are those small businesses.
they're everyone who's working, you know, during the day, and at night time they want to sell a product that they made on Etsy. Or they're folk who might be running an offline store at daytime, and then also want to take some internet orders as well. So there's, you know, our traditional customers not sending huge numbers of parcels, but they want to be able to send with the same, you know, same rates and the same quality of service as the big logistics companies out there.
Can you say how big your customer base is right now?
Look, we have tens of thousands of small businesses who are basically sending every single day with us.
And now, Australia Post actually took you guys to court over some of your branding. Why do you think they were so sensitive about? What was that case about?
Yeah, so we when we started, we were thinking about what's the way of describing what we are, and we thought of a great way of describing it, which is Post without the office. We can basically give you the same level of service, and we think even better service than lining up at the post office without having to line up. We will come to you and pick up your parcels and deliver them for cheaper. Unfortunately, and we thought it was a great way of differentiating from the post office. Unfortunately, Post believed that was different. They thought we were trying to pass off as the post office, and took us to court. Happily, it took about 2 years later, but happily, you might say the court agreed with us that, you know, really we weren't trying to pass off, and so now we won the court case, and we can use the trademark Post without the office. Oh, well done. Now, on a policy issue, I'm interested in talking about the tax environment in Australia. There's a lot of discussion about corporate taxes being paid, but also for smaller businesses and R&D research tax credits. Do you think Australia has a conducive tax environment for business? Look, I think for businesses the scale that we've been at, which is, you know, growing, I think the R&D tax concession has been really good. I know for us it was a great boost to be able to offset the initial research and development we had to put into our product. We can't find a business like Sendle anywhere else in the world. You know, for us that either means, you know, hopefully it doesn't mean we're mad, you know, hopefully it means we're really onto something. But we do get supported through the R&D tax concession to build our technology and to build our business model. I think the other pieces, you know, around Australia, Australia is a great place to start a small business as long as you can really leverage, you know, both the capacity we have here in terms of really smart people, but also I think, you know, the way we think about it, we're so dispersed. You know, if we can do logistics in Australia, we can do logistics anywhere in the world, because we've had to learn in a really rough environment for logistics. And so I think that, coupled with, the boost that we got, has made it a really great place to start a business.
All right, congratulations and best of luck, James Chin Moody. Thanks so much for joining us.
Thanks so much, Leo.
A very interesting fellow, David Chin Moody there, talking to Leo Shanahan. After the break, a shock move from David Teo at TPG, cancelling the planned 5G network rollout. We'll discuss the consequences for TPG with InvestSmart's Evan Lucas next.
Now, back to Ticky.
Welcome back. Well, big news in the telco sector today. TPG has scrapped plans to roll out a mobile network in Australia, citing the government's decision to prohibit the use of Huawei equipment in next-generation 5G wireless networks. Well, that would do it, wouldn't it? TPG has spent $100 million on its network rollout using Huawei technology, and another $30 million in capital expenditure has already been committed. Pretty hard to change now. But abandoning the rollout could also remove a major objection from the competition regulator, the ACCC, to TPG's proposed merger with Vodafone. And while TPG's David Teo says there's no connection at all, he's surely relying on Rod Sims seeing things differently now. If not, as Mr Teo says, it's back to the drawing board. Well, the move shows just how the government's ban on Huawei is hitting the telco sector. China has attacked the move, saying it limits competition for Chinese companies in Australia. TPG shares went up and down all through the day today. Now, meanwhile, the US Justice Department has filed 13 charges against Chinese tech giant Huawei, as we were saying earlier, and its chief financial officer. The charges include accusations of bank and wire fraud, obstruction of justice, and theft of technology from the US company T-Mobile. The case has strained relations between China, Canada, and the US.
According to the indictment, in 2012, Huawei began a concerted effort to steal information about a robot that T-Mobile used to test mobile phones. In an effort to build their own robot, Huawei's engineers allegedly violated confidentiality and non-disclosure agreements with T-Mobile by secretly taking photos of the robot, measuring it, and even stealing a piece of it.
Now, the company's chief financial officer is currently in Vancouver, and she awaits a decision from a Canadian court on whether she'll be extradited to the United States. Huawei denies these allegations. Well, for more, Evan Lucas, Chief Market Strategist at InvestSmart. He joins me now from Melbourne. Evan, look, I think actually TPG shares did end up over 3%. So take me through how the market's thinking about the decision today.
Look, you've also got to probably take it with a bit of a pinch of salt, and the reason I say that is that if you look at TPG's performance over the last 12 months, it hasn't been fantastic. So this does remove a slight hurdle. So that's the part of the way you look at it is, I think the market takes the idea that the merger with Vodafone is actually probably collative, better takeout over the years, rather than probably the deal with Huawei. So the rollout of using Huawei's equipment into their mobile network system was going to always have the headache of geopolitical risk. I think that's the way the market has been talking about that. And the news from the federal government of banning Huawei's 5G network materials is not new. They've been talking around this for probably about 12 months. It's been well known that they've been concerned about some of the outputs. It's not just Huawei either, so ZET, so ZEET is also under that same sort of microscope scrutiny, not just here in Australia, but overseas as well. So I think the market always had that idea that there was possibly going to be headwinds to TPG's idea of using Huawei equipment for their network. So that removes a slight hurdle. It removes that known issue. Yes, they've spent a reasonable amount of money, and there's no denying that at all, on doing this program, but they can now move down the idea that there will be, at least from the ACCC's point of view, there will be 3, maybe 4 providers on the network. So the ACCC likes that from a competition point of view. It looks at it from the point of view that they can have a mobile network with Vodafone through a JV, but continue to do what TPG has always done well in the past. Admittedly, it is a market, and I always talk about the telecommunications market in one way, a very saturated space to be. So the only way you can grow is through basically eating your competition. So that's the other way to look at this, is that they no longer have to throw a whole heap of money to try and grab mobile network off Telstra by using Vodafone as the JV.
But if you're like an investor in TPG now, say you're a Rob Milner at Soul Patts or whatever, you'd be banking on Rod Sims coming through with that decision, because if the decision is no, that's not going to be good for the TPG share price.
Correct, and that's the risk. So that's where you can also hear the slight hesitation / slight annoyance in David Theo's talk around that, is that, again, this doesn't, basically do almost a rubber stamping of the ACCC getting through on this. That's not the idea. It just, the market's response, and why it's only muted at 3%. I mean, if it was basically suggesting that this was going to be a certainty now, it would have jumped up 10.5% plus.
Yes.
It removes that risk. So what I would say, telecommunications as a whole is a very, very hard place to be these days. Consolidation has been happening now for 4 years, since the boom year of 2013-14. That year is gone, where there was about 6 of them. Consolidation was always happening and growth was going to happen. All that's been done. It's now, if you're an investor, you've got to ask yourself, where's the growth? It's hard to make that discussion in a saturated market like Australia.
OK, seems to have done wonders for the Telstra share price today. Though, now, look, before you go, I must ask you about the NAB business survey, and I look forward to CPI tomorrow.
Yeah, so very quickly, the NAB survey was the one outlier in all of the overall data that had been probably over-optimistic, so a massive pullback in conditions, and that's not an over-exaggeration. So it went from being as high as 15 all the way down to 2. So that is a collapse, and that is a big movement, and it was across all sectors. So it wasn't just like saying mining pulled back or financial services pulled back or retail. All of them did the same thing across trading conditions, profitability and employment. So that's a big change. And not only that, although it's for December, the survey was done fairly recently. So that's a big movement, and that is a big step back and shows 2019 is a bit of a headwind. Tomorrow's CPI is even more important. It looks like being the 15th consecutive quarter in a row that we will see inflation below the RBA's mandated number of 2 to 3%. And therefore the question becomes, with what just happened in business conditions and what we know about the rest of the economy, At what point does the RBA have to start going, maybe, just maybe, we're going to have to consider that going up is unlikely to happen anytime soon, and maybe more likely going down is possibly the next movement. I'm not forecasting any movements at all. They don't want to, but inflation is now stubbornly low.
But rather different from what our governor had been saying all through last year. Anyway, Evan Lucas, that's really interesting. Thank you very much for that. Good to compare that Deloitte and the NAB report. But that's all for the show tonight. Tomorrow night, I'll be speaking with Telstra CEO Andy Penn on the future of work in Australia. That'll be following a keynote speech at the CEDA event in Melbourne tomorrow. And later on, I'll be talking with David McCready, CEO of Australian British Chamber of Commerce about all that Brexit stuff. Until then, thanks for your company.